Hello students. In today's lecture, we'll be discussing about the dividend policy. Dividend policy, and we'll take the topic of factors affecting the dividend policy. So what is dividend policy? The dividend policy means the policy concerning the quantum of profits to be distributed as dividend. How much profit is to be retained by the company, and what part of the profit is to be distributed as dividend amongst its shareholders. That is to be decided by the company, and that is known as the dividend policy of the company. The board of directors of the company decide as to how much profit should be given to shareholders in the form of dividend. In practice, generally, many companies do not have a dividend policy, and in that case, the companies take each dividend decision independent of every other such decision. That is, every year when the company decides to pay dividend, depending upon the profits and depending upon its future financial requirements and depending upon its investment and financial decision, the company takes the dividend decision and company decides about how much dividend it is going to pay to the shareholders. Moreover, the decision regarding the dividend policy and how much amount to be paid as dividend, how much amount to be retained by the company, that is decided by basically the board of directors, and the financial manager is dependent upon the board of directors, and he is required to do according to what is given to him as direction from the board of directors. Paying dividend involves outflow of cash, and the cash available for dividend with the company will depend upon its investment and financial decisions. For example, if a company is going to purchase some asset in the coming future, it is going to incur some capital expenditure, so it will need cash in the future. Therefore, the company will be paying lesser dividends. And in this sense, the dividend decision of the company will depend upon the investment as well as the financing decisions of the company. Factors affecting dividend policy. There are a number of factors which affect the dividend policy of any company, and those factors can be studied under two major heads, that is internal factors and the external factors. So far as the internal factors are concerned, they are the regularity and stability of earnings. Regularity and stability of earning means if the company is earning profits on regular basis and there is stability in the earnings of the company, then company can afford to pay more and higher dividends to the shareholders. And obviously, if company is uncertain about its earning and earnings of the company are not regular and not stable, then in that case it won't be possible for the company to pay regular and higher dividends. Financial needs of the company. Financial needs of the company means how much cash company needs for the future. Whether the company is going to incur some capital expenditure in the future and it will receive cash and funds for that purpose, then in that case it will keep more profits with it and it will pay less dividends to the shareholders. Desire of the shareholders. So desire of the shareholders is also one of the factors which must be considered by the company when company decides about its dividend policy. Generally, the desire of shareholder is taken as of two types. For example, the shareholders may want a return from the company either in the form of dividend, or they may want a return from the company in the form of capital gains. Dividend means the regular return which they will be getting from the company, and capital gains mean the earning which or profit they will be earning when they will be selling the investments of the company. So, if the shareholder wants a regular return, he will be more interested in the regular dividends. Then in that case, the company should pay a regular dividend to such shareholders. Desire of control. At the same time, the desire of control is also one of the factors which is considered by the company while framing its dividend policy. Because if company wants to keep and retain more control over the company, then it won't be interested in issuing more shares to the company, because if company issues more shares in the market and it raises more funds by the issue of equity shares, then it will lose control over the company. The present shareholders will lose control, and they will obviously it will reduce their own say in the company. And raising funds through the long term loans, etc., that will also cause risk to the company. So that's why desire of control should also be considered. Liquidity position. Payment of dividends results in the outflow of cash, and therefore if company is earning profits and company is having sufficient liquidity, then it can afford to pay more dividends. But if the company's liquidity position is not good, then in that case company should pay lesser dividends to the shareholders. Next comes the external factors. So far as the external factors are concerned, they are the state of the economy. State of economy means how the economy is going and how the economy is doing. For example, if the economy is doing well and economy is growing, then in that case company will have more profitable opportunities. Then in that case company can retain profits and it can invest in the more profitable opportunities. State of capital market. If the company is having an easy access to the capital market or share market, then company can pay more dividends to the shareholders. And in case company is not having any easy access to the capital market and there are not favorable conditions for the company for the purpose of raising funds through the issue of shares from the capital market, then in that case it should pay lesser dividends and it should keep more profits with it. Legal restrictions. Sometimes the restrictions are imposed on the companies by the Companies Act regarding the payment of dividends. Then in that case those legal restrictions should also be taken into consideration while framing the dividend policy. Contractual restrictions. Sometimes when a company raises loans from some financial institution or bank or from some other party, and in that loan there is a condition, for example, if there is a condition that company won't pay dividend so long as the liquidity ratio is less than 1:1, so then in that case this would be a condition, this would be a contractual restriction. Similarly, the condition may also be in the form that the company will not pay dividends more than 4 or 5%, so long as the loan is cleared by the company. So then in that case the contractual restrictions also affect the dividend policy of the company. Taxation policy. Taxation policy means how much tax is charged by the government on the profits of the company. If more tax is charged, then in that case company be there with lesser profits, and lesser profits will be left with the company, and company obviously will not be able to pay more dividends. And in case less taxation is charged by the government, then company can pay higher dividends to the shareholders. Thank you.